I told you, I made you a promise that I would make sure you know all there is to know about buying a home if you are interested. I meet so many first-time home buyers, and what's stopping them is they don't know what to do. So today we are joined by Manny, the mortgage guy, and he's going to talk to us about the real estate market in 2025. Welcome, Manny.
Awesome. Thank you. Nice to be here. And appreciate you asking me to come and chat with you. So I'll just, I guess, do a little intro. I'm Manny Rizzuto with Cross Country Mortgage. I've been originating mortgages since 2001, so it's a little bit of a long while. I've seen a lot of ups and downs. The market right now is really competitive. I think I'll be an excellent resource for you to answer questions, concerns, any types of roadblocks that you have in your head about, being a first-time home buyer. My favorite things to do really are to help those clients where they feel like they're not going to be able to accomplish their goals.
Yeah.
They're kind of just stuck, like we were talking about before, where they think, oh, well, I might be able to do this, I might be able to do that, I might not be able to.
Yeah.
And then ultimately they just get stuck. I like to unstick people, I guess. Maybe that's what I like to do. That's really, I think, where it starts. It's not about rate, closing costs. That's all important, but that's never gonna happen if you don't have a conversation with somebody.
Yeah.
Like I was saying, you're talking about your client that's got a place that they might sell or they might keep as an investment property and buy another, then they might not go anywhere. So, I'm happy to be a resource to anybody who's watching, and I'm glad that we got to sit down here.
Yes, people call me all the time, Manny, and they're like, yeah, well, I'm thinking about buying a house, but when I pass them over, have the conversation with a lender first.
Yep.
What do you tell someone who they feel like they don't need to speak to a lender until they're actually ready?
Yeah, they're
to
not
buy?
ready yet.
Yeah.
They're not ready yet. Well, I just said this to somebody yesterday. As soon as you think that you want to buy a home, then you're ready to talk to a lender. It's time. Like, you're already behind if you don't do it the moment that you think to yourself, my life is in a position where I would like to purchase a home. That's the same day that you should talk to a lender. It doesn't have to be me, but it'd be nice if it was. No, it doesn't have to be me, but in all seriousness, you have to go to somebody that you trust to go through the details so you can, again, take those roadblocks down that you have in your mind. Like, some people think they have to put 20% down. You don't have to. First-time home buyer can do 3% down and get up to, if they're a first-generation home buyer, they can get up to $22,000 of down payment assistance in the state of New Jersey. Mm-hmm. And we have down payment assistance programs in all 50 states. We lend in all 50 states, but since we're here in Jersey, you can get $15,000 of down payment assistance in many counties, $10,000 in another. If you're first generation, you get another $7,000. So I think, what I would say to those clients that say, I'm not ready to talk to a lender, I think it's because they're nervous. I'll liken it to the first time I went to a financial advisor, right? I had to show them all of my information. I was nervous. I was like, is this good enough? Am I good enough? Is really what I thought. And, I imagine that's what my clients coming in to talk to me about mortgages. It's the same thing. They're showing me pay stubs or W-2s, their credit. Oh my God, I don't know if it's good enough. It's all this feeling of I'm not going to be good enough. I think that's what stops them. Yeah. So I just try to be very approachable and make them understand that they're not buying a house today. They're talking about it.
Exactly.
They're putting a plan together. And if they're going to buy a house in 6 days, 6 months, or 6 years, it's great to have a plan. Yeah. Right? So, and then when you have the plan, and it's funny, the person that says they're not ready and I give them their mortgage pre-approval, I'm buying in a year, I'm buying in 2 years. Well, all of a sudden they buy in 6 days, or because all those obstacles are gone. Yeah. Right. And then the other people, if they have a challenge, well, they need to know that too. I mean, you got to think about that. If you think you're credit challenged or you think you don't have enough money saved, well, you need to know that. That's even more important when you're not ready, but you want to buy a house. You need to know then, because if you don't know how to overcome your obstacles, and then you're ready in a year, but you didn't do anything. Yeah. It's very counterproductive. And I hope this is coming across nicely, because I'm never the pushy guy, but I think you're on borrowed time. The minute your heart wants to buy a house and your head wants to buy a house, then you need you need a guy like me. No, I'm just kidding.
Call me any guy.
No, but in all seriousness, that's what I say. I mean,
Yeah.
I think that's, important, because when you get the obstacles taken away, then everything else is easier. Then you can enjoy looking for houses with you.
Exactly. That's when you call me. And that's what I tell them.
That's
I'm
it.
like,
This is how this works.
it's how it works. I'm like, talk to the mortgage person
Yeah.
first. They're going to give you a little piece of paper.
That's
and
it.
now we can go shopping. That's my favorite part.
Yeah.
Yeah.
Well, same. And that's like what I want to give people, is that freedom to not feel the stress of trying to purchase a house.
Yeah.
If they're looking at a home and all they're worried about is the dollars and cents, then I didn't do my job, right? So to me, it's give them to you with that clean slate of take me to see some homes, Kim.
Yeah.
So that's it. Yeah.
Right. And are there any markers that you hear from someone and you're like, oh yeah, this person is ready? Because it's like I run into people and I'm like, you've been on your job for 20 years. Why are you still renting?
Yeah, it's funny.
You know?
So, there's sometimes I get introduced to people and I do, after I build some rapport, I say to them, what have you been doing? You make a heck of a living. You have money saved in the bank.
Yeah.
So credit is always, something that I discuss with people, even when they have very good credit. I sit there and I review the credit report with the client up front, because there are times where somebody co-signs for somebody for an expensive car,
Yeah.
an $800 car payment, and it's co-signed for Aunt Jane. Well, I don't have to calculate that into that buyer's debt to income ratio, and that payment's going to blow everything up. And if they try to go get an online mortgage pre-approval or a big bank, they're not doing that. They're just going to look at the numbers on the piece of paper and say, oh, their debt ratio doesn't even work. You can't get a pre-approval, or they don't even do all those numbers, but that's another story. But if they do, they're not digging into that. For me, going through the credit is very important. Even if they have an 800 credit score, I want to go through the debts, make sure it's accurate. And if somebody's got a challenge on their credit, that's where, I can either refer them to a credit repair person.
Yeah.
A lot of times I can give them advice because I've done this for so darn long. I know what the tricks are to get a credit score up very easily. We have what's called a wayfinder and a what if simulator. It's two things that we use on our credit reports that we pay for. When we do a credit inquiry, we do a soft credit pull. So number one, we're doing a soft credit pull, which gets all three credit bureaus. A lot of companies only use one bureau, and that's never going to give enough information for me to give them an accurate interest rate, because you need to go with all three, because interest rates that you're going to get are going to be based on the middle credit score. So it's their high, low, middle, right? Middle credit score, middle FICO score. And so, I have to have all three of those. But the soft pull doesn't ding your credit score like a lot of people come to me and ask, to your point, they don't want to have their credit pulled. That's another obstacle. Oh, I don't want to have my credit pulled. I don't know how good it is. We don't ding the credit score with a soft pull, but we get all three bureaus, we get all the debts, and then I go through it with them. And if there's issues with the score, if it's low, I'll tell them on the Wayfinder to find a way, aptly named, but to find a way to get a higher credit score. It'll tell them a potential score improvement on my credit report. Let's say you have a 580, a 560, and a 600 credit score. And then next to it, it'll show me in the next column a potential score improvement of X amount of points on each bureau. And those are based on them being able to do some tricks and things, pay down some debt, restructure things that I could go over with them to help them get to the higher score, and either achieve the down payment assistance that I was talking about before, or to achieve the higher credit score to get a better rate. My goal with these clients is to give them all this information, like I said, the minute they want to buy a house, so they can do all this preparatory work.
Exactly.
And then when it's time, when they have the house or find the house, they can have a better credit score. Because again, if they sit on the sideline and wait until they're ready, well, then they didn't get the opportunity to improve their score.
Yeah.
And now they're going to pay more in fees and more in rate. So like I say, the earlier that you come, whether it's credit or whatever, it makes all of our lives like just easier, and including mostly important, you guys that are watching. It's that much easier.
If you have a student loan, do you have to pay that off first before getting a mortgage?
I would never recommend paying off a student loan ahead of a mortgage application, or any debt, really. I get that like a lot, and you probably will get that as a realtor, where, oh, well, I don't want to apply right now. I want to pay off my student loan, or I want to pay off my car, or I want to pay this credit card down, or I want to do something to my credit, right? They might be vague. I need to get my credit right.
Yeah.
Right? They might just say
right.
that. I want to get my credit right,
Yeah.
which that's great, and I appreciate that. But there are many tricks of the trade to do it efficiently. And when you're talking about money, your money, right? You don't want to spend $1,000 if you could spend $5 and get a better result. It's your bang for your buck. So ultimately, would I tell somebody to pay a student loan off? I haven't done that I don't remember a student loan being a debt to say pay a student loan off, because the monthly payments are so low based on the calculations. If there's no payment on credit, because sometimes they're deferred, we calculate a very, very small, it's like a 1% or a 0.5% of what the client has in outstanding loans. So typically the student loans are not as bad of an impact as maybe the media would put out there, or maybe people might think in their minds. So again, it's the conversations, right? They would learn that and not waste their money.
Yeah.
Right? And then they could save that money for the down payment on their house, as opposed to wasting it paying off debt that might not need to be. So again, like talking to me before they do all of that, I might tell them to pay off a debt. Maybe there's a credit card that's got a huge, minimum payment. Okay, well, we're going to hit that. Maybe there's a car loan that's only got, a few $1,000s on there, but the car loan payment is $800 a month. Well, and they might have a few $1,000s to just wipe that out. Yeah. Now there's no $800 payment on their credit report. That's freeing up your debt to income ratio, as opposed to taking that couple thousand or few $1,000s and throwing it at a student loan that's not going to accomplish that same payment, right? It's payment based. Right? Your monthly payment is what we're focusing on when it comes to debt to income ratio. It's not that you have $100,000 in student loans. It's the payment that we're focused on. Hopefully that answers the question.
Manny, you answered that beautifully. You are dropping jewels on us today.
I ramble on a little bit.
But no, I love you are in depth. So, all right, what if, Manny, we got this the student loan debt out of the way, but we have a lot of credit card debt.
Right.
And would you suggest someone to consolidate all of their credit? Does that make sense, or is this still just kind of the same debt and going to affect you the same way?
Yeah, no, I mean, if you have credit card debt and you're trying to obtain a mortgage, obviously the less debt that you have, the better. The less the monthly outlay, that's better.
Okay.
Consolidating the debt, it depends on what it's going to achieve, because not that it wouldn't be better financially to consolidate the debt, if a credit card's at 29% or something like they are these days, or 22% or whatever, and then consolidating it into a 10 or 12%, debt consolidation, personal loan kind of a thing. That's obviously better from an interest standpoint that they're paying. But what might happen is, let's say those minimum credit card payments only equal $1,000 a month. I'm just making this up. And then they're going to sign up for, a consolidated payment that's going to be at a lower rate, but it's maybe a shorter term that they have to pay it off in, and that payment goes up to $1,200.
Okay.
Now all of a sudden their debt ratio is actually worse. So I'm not saying don't consolidate your credit card debt. That's not what I'm saying. But I guess it goes back to what you asked me before, or what I answered before about the student loans, is before you do anything, talk to me,
Yeah.
because I'll be able to look at your credit. Again, it's a soft credit pull. It's not going to hurt the scores. And then I'll be able to really give you a good plan as to what is right for you, you know,
Okay.
because it's hard to answer your question sight unseen. If I see somebody with the debt structure, I can tell them 100 times out of 100 what's the best to do.
Okay.
You know, and then they can tell me, well, I applied for this, you know, debt consolidation. Okay, well, what's the monthly payment going to be? Tell me that before you sign up for it,
Yeah.
right? And then we could map it all out.
All right, Manny. So if you're an authorized user on someone else's credit, does it help you or hurt you in the long run if you're trying to buy a house?
About, you know, being an authorized user, I'm not a credit repair person, you know, like your husband. So, but I can give people guidance on it. Adding as an authorized user, I think it's a trick that can help.
Okay.
But it depends on what you're bringing on, right? Like bringing in an authorized user on a credit card that's maxed out probably isn't going to help you. So we got to figure out, again, the game plan, you know, but that is one of the tricks, I would say, you know, to showing a little bit more credit depth and credit availability, you know, on your report by adding on to as an authorized user.
Okay.
Yeah.
All right. So Manny, we've got them past the credit. You know, they've had the conversation with you. They went to my husband for credit repair if they needed it.
Yep.
And now they're looking to see what is the next step in buying a house.
Yeah, so we have the pre-approval, right? Is that what we've got that? The pre-approval's done. You know, ideally I've reviewed all their income, you know, pay stubs, a couple of pay stubs, just two.
And Manny, what if they're saying, well, actually, I don't have any documents of my income. I've been getting paid cash.
Well, that's going to be a tougher one, you know, because you got to document income in most cases, especially if you're a first-time home buyer. There are alternative income documentation loans where we could use bank statement averages, you know, if they're depositing the money in a bank account rather, you know, we could use the average deposits. That's mostly for a self-employed client. So like, it's a good idea for those who are self-employed. You know, most self-employed people, they take, you know, their income and then they use their accountant to fill out their deductions, and then their taxable income is lower. Well, we're scoring their loan or building their loan out based on that lower taxable income. So if you're using bank statements, let's say, then we could average those out over 12 months, you know, whatever the deposits are in those bank accounts, and don't have to take in the tax returns. That's one option. The other option is, you know, if you're looking at buying an investment property, then we don't have to verify income either. We can do basically what's called like our investor cash flow loan or debt service coverage, where, you know, we use the projected rental income to qualify based on that income on the actual property. So we don't have to document income in that case. But that's typically not for a first-time home buyer.
Yeah.
So mostly, I was trying to think, mostly a first-time home buyer is going to need to show income unless they're self-employed, and then they could do alternative documentation type.
Okay.
So those are kind of, without getting too far into the weeds, that's kind of the answer for it. Yeah.
All right. And Manny, right now we know it's a great time to be a seller still. You know, is it a great time to be a buyer?
Well, I think, you know, that's, you know, the beauty is in the eye of the beholder. I don't know, that's cheesy, but it's true. I mean, you know, it's the market right now is challenging for buyers. Let's say it that way. But look, I think it's been challenging for the last 4 years too.
Yeah. Right.
So if we rewind time and say, was it a good time to buy 4 years ago for a buyer? You might have said 4 years ago, oh, I'm not ready. Prices are too high, even though interest rates were a lot lower, right? A lot of people didn't do it. A lot of people probably that are watching right now that were considering it didn't do it because they thought, well, these housing prices are too high. Well, 60% pricing increase later, right? Because that's a lot in our local area here in New Jersey. There's been 60% housing price increase in the last 3, 4, 5 years. So I think, is it a good time to buy now? Yeah, because if you're ready to buy, right?
Yeah.
If life says it's time to buy, I would say yes, based on need and based on what the numbers are going to shake out to be, because rent is very expensive. I mean, I was just talking to a client who's buying a house at $407,000 is what exactly his offer was accepted at. And he's renting now for $2,200 a month, which is not terrible.
Yeah.
But he was going to have to move out of that rental and go into another one, which is going to be $2,500 a month. $407,000 condominium, principal and interest, taxes and insurance, and the association dues. So everything included was going to be $2,850 a month. So you compare $2,850 versus $2,500 and you're going to build equity and build wealth, through homeownership. I think it's a no-brainer to buy, right? And I think that's a lot of what is it a good time to buy a home is based on, right? It's what's your option. If you lived at home rent free, I guess that could be an option, right? So it's a case by case. Is it a good time to buy? Yeah, if we can talk through the numbers, right? If you're living for a cost of zero and saving up, well, it's still really a good time to buy because you want to start your home ownership journey. What I will say is it a good time to buy? Well, any CPA and any financial advisor that I work with that refers me business, when they look at their clients' financials, their wealthiest clients, what they all have in common is they own homes, they own real estate, multiple properties in most cases. Those are the most wealthy people because they build wealth through home ownership, they build equity, they pay down a mortgage, and they have multiple properties over time. So you can't have multiple properties until you buy one. So I believe in my heart, you can build wealth through home ownership. So is it a good time to buy? Yeah, because if you buy a house now and in 20 years from now, chances are it's going to be worth more money than it is today. And, we're not getting into this as a fix and flip kind of thing. Most of our viewers are probably going to buy the house to live in and to be there for their family. So it's not like they're looking to turn it around in a hot minute. So I think it's a great time to buy. And then later on, you refinance to get lower rates. You can always do that to manage that debt. I'm not going anywhere once I close the transaction. I manage that debt, so I think it's always a good time to buy, but that's just the mortgage guy saying it.
I know. I feel like you got me some business with that answer. Now is the time to start building your wealth. And we are wrapping up here, Manny. Again, thank you so much. I do just have one final question.
Sure.
Because you spoke to me about buy downs last week, and I just found that so interesting to be able to kind of lock in a rate, for a couple years to just kind of wait out maybe the storm that we're having right now.
Yeah, so there's two things that we've discussed, is that there's a 3-2-1 buy down, there's a 2-1 buy down. And what that does is it lets you take your interest rate. Let's just do the 2-1 buy down for this example. It lets you take your interest rate. Let's pretend the interest rate today is 6.5%. Okay, you could take that interest rate down to 4.5% in year one, and then 5.5% in year two, and then 6.5% in year three. So it's the 2-1 buy down. You buy it down 2%. So you get those 2 years, right, at below the market, 4%, 4.5% in year one, 5.5% in year two, and then it goes up to 6.5% in year three. These are fixed rates, by the way. The rate is not adjusting. It's just being bought down, and typically that's funded by the seller. So you can build that into your offer, whatever the cost is to buy down that rate. And obviously I would explain all that in detail to make sure they understand. But ultimately you're building it. If it costs $10,000 to do that buy down, or $5,000, whatever the numbers are, it's based on how much you borrow. So you have that buy down. It helps you get the lower rate, the lower payment. And then the idea is during that time, as the mortgage progresses, we can look at refinancing if rates come down, or at that point in year three, you're at 6.5%, and that's for the life of the loan. It's not an adjustable rate mortgage or anything strange. So it's a great way to make some home affordability, right? That's ultimately what we're talking about. It's to make your home a little bit more or a lot more affordable.
Okay.
So, yeah.
All right, well, thank you, Manny. I think we're going to have to do this again, Manny, because this
Okay.
was a lot of information.
It is.
If you have any questions for Manny, you want to reach out to him, I will make sure I link his information. If you are in need of credit repair services, I will link my husband's information. Or if you just want to reach out to me and have me connect you to who you need to be connected to, make sure you reach out, and don't forget to like, subscribe, and comment below.